Hey guys, Mike here. So we got a huge week ahead, so buckle up for some volatility. I'm actually really looking forward to this week versus last week because I think there's definitely going to be some roller coaster days there, or at least caused by what's happening. I mean, we got huge amount of earnings, big data coming out this week. Also, we got OpEX, and I'll show you the put calls on that one. It's just unbelievably skewed in one direction, of course. You also might notice Fintech fell off a cliff on Friday when some news got announced by the large banks. We'll go into that because we'll get to hear a lot more about that because the banks report this week. And I do think it's a very big deal for fintech companies if you happen to own them as well. And so, again, we'll go into some charts to watch out for Tesla, Apple, and some others. But let's start off with this right here. Because remember, we're starting the second half of July this week. And let's see what that usually looks like. Usually it's the first 2 weeks. Again, that's usually the most bullish out of the year, actually. But then the second half, the reason why is because of OpEx, earnings, everything else is happening right here. And we're going into August, September, of course, after this, which is usually the worst 2 months of the year, or two of the worst months. But when we look at what happens when the S&P 500, after 3-month gains of 25%, which is super rare, as you can see, what happens after that? Well, 1 month after, you can see is super mixed, only one good year, 2020. If you look at 3 months, you can see it's green, 6 months. So everything else looks pretty good. This has to do with breadth, right? If breadth expands out, this is when you get those gains going 3, 6, 12 months out. Okay, it's just 1 month after. It's iffy, okay, to say the least. Now, look at an OpEx. There's no puts in sight. I mean, look at that. You can just everything. If you can't see this, these are call percentages, right? So indexes, 91% calls. ETFs, 83% calls. Single stock, 78% calls. And then S&P 500, 90.5% calls. The other section is the puts. And so super, bullish going into this. Everybody is. Nobody. That's what I was talking about, the put call ratio, how like nobody's really trying to protect themselves on the downside right now. And you can see it in the VIX. I mean, we got in the 15s, got a little bit of pop the other day. But as Jim Carson talked about, he expects vol to continue to be compressed downward. So we could see in the 14s. If that's the case, now we could absolutely see that if earnings are good and the market likes what it has to say and the forward guidance is good, and stocks, especially the ones that actually have weight to them, start pulling Delta Airlines and start reinstating guidance and everything, then you could see it. We just got to wait and see. But instead of the VIX, watch the move. This is the volatility index for the bond market. This helped us out when we went through that whole the tantrum on the tariff and stuff like that and started crashing. But it's in this zone, which for the last year, but over the last year, is where it's gotten a bounce, right? It got a little bit of bounce the other day. But understand, can this drop lower? Yeah, that's right. If the bond market is just fine, right, because we know Treasury's been stepping in quietly, Fed's doing stuff, yeah, we could absolutely see it drop. We did right here. Remember, we're at this level for almost 2 years. And then all of a sudden, boom, started going lower. And so watch and see if it breaks down below this level, which would be good for stocks going up because the bond market's all good and everything, and they're not seeing any risk. Or if you see a bounce, we start to move out of this box going towards the upper side, that means we're definitely going to get a pullback in the market for sure. No ifs, ands, or buts about it. And another telltale sign you're seeing just risk on, which is crazy, is these leverage ETFs. I mean, they're rolling out so many of them every week. It's insane. On every single, like Mag 7, I think, has them now. And so when you look, shockingly, yes, we're at all-time highs. And the crazy part, this right here will probably be 2023 right here. And just look at the rise, right? That's in billions to the left over there, by the way. So just billions and billions of dollars flowing into these leveraged ETFs. What could go wrong, right? So which is why you see these big moves up and down. We do get them because everybody's so leveraged to the hilt. But when you look at earnings here, obviously, you got Fast on Monday, nothing else after that. But the big one is going to be Tuesday, right? You got JP Morgan Chase, Citi, Wells Fargo, BlackRock, State Street. So the big boys. Albertsons and grocery store. Again, you can go with JB Hunt and a couple other regionals. Watch the regionals really because of IWM, right? Wednesday, ASML. Then you got Goldman Sachs, Bank of America, Progressive Insurance, Johnson & Johnson, Morgan Stanley, PNC Bank. Then United Airlines, Alcoa. and then more regional banks. So again, watch IWM this week. And then Taiwan Semiconductors Thursday, PepsiCo, see if that finally gets out of the graveyard. Cintas, Bancorp, Travelers Insurance. Then there's Netflix, which has just been going crazy. Interactive Broker. And then we got Huntington, 3M, and then a bunch of regional banks. Also, there's also American Express reporting as well. What's funny about this, the one out of all the major stocks that has the biggest expected move, which will surprise a lot of people, it did me, United Airlines. It's like a 9% expected move next week for them. I think that's because after what Delta did. And the good thing is, when it comes to banks, you can see they're all at all-time highs. But what have they been doing for the last week? Pulling down. Like, I'd much rather own a stock that's pulling down going into earnings than one that's just absolutely going, parabolic. Because at least, and then they're expected to support really good earnings because of deregulation and stuff that's going on. And something else, which I talked about in the beginning right there, and has to do with Fintech, okay? And you can see Citi, I believe they're all at all-time highs, if I'm not mistaken, but they just either consolidated and pulled down about 5-6% last week, which is not a bad thing going into earnings at all. Now, Monday, no data. Here comes CPI on Tuesday. Then we're going to end up with PPI on Wednesday right here. And you'll have a few other things like industrial production month over month, crude oil inventories, the beige book. Then we'll roll into Thursday. We'll get core retail sales month over month, unemployment claims, Philly Fed manufacturing index. Not anybody cares about manufacturing anymore, it seems. And then on Friday, building permits, housing starts. And then the preliminary universe admission, consumer sentiment, and inflation expectations. Now, as we talked about, this is what JP Morgan put out the other day. They're telling fintechs they're going to have to start paying up for customer data. And you can see like all of them, boom, they go down like either from like 5, 6, 7% all at the same time. And so for those who didn't realize, they've been getting this data for either free or cheap or whatever, but they're going to start increasing those prices. So this is more revenue for the banks. And of course, even SoFi even fell. And so what this means, when we kind of read through a little bit, according to Bloomberg, JP Morgan has distributed pricing sheets to data aggregators outlining new fees that could amount to hundreds of millions of dollars. These aggregators serve as intermediaries connecting banks and fintech companies. The fees will vary based on how companies utilize information, with payment-focused firms facing higher charges. JP Morgan spokesperson stated the bank has made significant investments to create a secure system. This is the one I really love. Protecting consumer data. We've had productive conversations and are working with the entire ecosystem to ensure we're all making the necessary investments in the infrastructure that keeps our customers safe. The move by the largest U.S. bank could potentially disrupt business models across the fintech industry, as companies that have previously accessed customer banking information without direct charges would now face substantial fees for this data. So watch that. We'll see how they react on Monday. Obviously, the futures are red right now. But when you look, I do want to compare these two because like there's SoFi and there's Robinhood. This is Robinhood's chart, right? It's rounding bottom, big pullback there, and boom, all-time highs, right? Here you got this rounding bottom, very choppy, just like that, big pullback, same right there, and then it's just rocketing higher. Both are huge when it comes to not only retail, but also institutions are noticing this one as well when it comes to SoFi. They already noticed Robinhood, of course. And so just watch it because it seems like they're kind of playing out the same way. So if we continue this bullish move up, this would easily finally get new all-time highs, which is not really far off of. So it's definitely been surging. And remember, they actually they have a banking charter, unlike a lot of fintechs, because they did buy a bank, a regional bank that is, about 3 or 4 years ago. And here's Hood's chart. Again, it eclipsed 100, okay, and then sold back down as soon as this news came out. Which, maybe it affects this one as much, but, I don't really consider, because Hood's, like I said, it's like everything, right? It's a trading platform, it's under fintech, it's crypto, all that stuff. But again, if it does come back down, there is that weaker fair value gap we didn't even touch on this one. But also, if we continue up, because it's such a, just powerful name right now with so much buying pressure on it, 110, definitely next level I think everybody's looking for. We'll see how this week plays out and everything. But yeah, this is definitely one that's up there. It's just, and when it came back down, like I said, I don't think we'd go under 90, hit that, but we hit that 0.5 fib and bounced hardcore. Now, looking at the indexes here, you can see S&P, R-SPY, whichever one you're looking at, all it did was consolidate in a 1.2% range all week, just waiting for this week, waiting for earnings, start coming in, waiting for the banks and everything to start reporting. We would get a chance to touch this trend line. That's what we're going to have to find out. Maybe see what happens to get a third touch. I think if the trend line breaks, maybe we finally get some kind of, downward pressure or whatever it is, which, would be great. I mean, because it would test the previous all-time high, retest that is, come back into a weaker fair value gap, feel the other volume gap right there. You look at, upside, if banks start just killing it, the market loves what wants to hear, 65.03 is your next film level. If this decides to start moving up over the next couple of weeks, start grinding higher. And again, I don't think you may be surprised by that, to be honest with you. I mean, it's been such a crazy recovery, and it's all about the breadth, right? Because banks are doing well, industrials are still doing well, but they've been front run a lot. And so that's really the bigger question, because this is a big move, okay? So how much is already priced in? That's what we never know until we get to hear the earnings, right? The Q's done the same thing, just consolidated for the last week right here. It's nowhere near the trend line, so the question is, are we going to break up, break down, watch for any form of rotation? You saw a little bit of that out of IWM the other day, but just see if maybe some starts to come out of tech, people start taking a little profits because they moved up so much and start rotating into other areas, which is not bad, right? That means the breadth will be improving, and that's what you're looking for. Or start to see if anything starts to rotate as we get close to August, going into the defensive names. That's a whole nother thing, and the healthcare, things of that nature. You haven't seen that so far. That's what we got to watch out for coming up here. It's not that money's pulling out of the market, it just moves into other areas, right? Because tech has had a big run up, especially the high beta stuff. And that's why I saw IWM. A lot of high beta stocks pulled back 5, 6, 7, 10% on Friday. So did IWM. A lot of regional banks reporting, which are on IWM. So that's what we got to be looking for. I'm going to put this trend line here for maybe a 6 touch if it does come down. But really want to see a bounce here for IWM to have any chance going higher. I think obviously the regional banks will have a lot to do with that. I'm not sure about how much they will be getting deregulated versus the larger banks, but I'll start reading more into that. Let me know in the comments if you happen to know anything on that. So again, let's look for that right there. Again, July is usually pretty good for small caps, but we're just going to start watching for any form of rotation out of that high beta stuff. Tesla, we talked about this. Again, filling the gap. That's what it did, right? So we waited for it. That's what happened. Start counting it out. You draw a trend line. You see a break above right there. And so not a huge day or anything, but it got the gap filled. And once it did, it stopped. And so where our next draws on liquidity is usually how we've been treating Tesla every week. And it seems to work out so far. Again, we break the white line there, 331, 339. That would be a good area for this to move up to as far as liquidity. Break this trend line coming down right there. Finally get that 285. 290 move down. That's what we're looking for. They won't be reporting. I think it's the next week. I have to go double check that. But again, the Mag 7 does not report this week, as you can see. Well, yeah, because Netflix didn't consider Mag 7, so that's true. The other thing to watch out for if it moves up or gets rejected, 250 are right there. Okay, so just keep that in mind. Last time we hit up there, we got rejected. Big move back down. Also watch, as usual, NVIDIA. If NVIDIA gets to rolling, I think you can forget about Tesla moving up really at all. So that's key if that whole paradigm holds, as I've showed you many times on the charts. Watch Apple here, sitting at that all-time anchor VWAP. We can get above. We're going to fill the gap and retest the 200 between 220 and 222 right there. That's going to be key. So far, it seems like it's saying as soon as it moves up, it can't hold the gains or anything, because the news they're putting out is just a mess. The iPhone and everything, but they need to start putting, again, I'm not wishing for this, but they need to start putting out headlines about, AI is replacing people and we're going to save a lot of money on that. Or, hey, we finally hired or bought this other company's AI company. I think that's what it really, really needs here for sure, because they don't usually guide, right? And it looks like it's trying to form this bullish flag pattern right here. So let's see if we do get a breakout this week at all on Apple. And again, once it gets above 200, it will run as you've seen in the past. Okay, so anyway, try to make that condensed, concise for you. Please hit the like, subscribe button. Let me know how you think this week is going to go. If any of your stocks are reporting, think about signing up for the membership. Less than McDonald's combo. That's everything you get with it. And all you got to do is hit that link down in the description right there is the very first link. And I will see you guys tomorrow for another fun one. So buckle up for volatility.